Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
Today, we're sharing 3 stories. First, we're looking at Nvidia's new robot brain, the Jetson AGX Thor chip, and its nearly $3,500 price tag, and why CEO Jensen Huang calls robotics the company's biggest growth opportunity. Second, we'll cover why a $2 trillion wealth fund is stealthily dumping nearly $3 billion in assets from companies like Caterpillar, Bank Hapolim, Bank Leumi, citing unacceptable risk. Third, we'll explain why Keurig Dr Pepper is spending $18 billion to buy JDE Peet's, only to then split its entire business in two, a strategic reversal designed to challenge Nestlé. Nvidia just put a price tag on a robot brain, and it's a cool $3,499. Now, that price is for the developer kit. If you're a big company buying in bulk, say over 1,000 units, the price drops to just under $3,000 per module. This high cost of entry suggests that well-funded giants have a huge advantage, while smaller, innovative startups might struggle to afford the very best brains for their creations. This isn't just some minor upgrade. The new Jetson AGX Thor chip is a monster, running a massive 7.5 times faster than its previous generation. It's powerful enough to run the generative AI models needed for the next wave of humanoid robots and self-driving cars. What's truly revolutionary here is that running these huge AI models directly on the robot is a complete game changer. Until now, many robots had to send data to the cloud for processing and then wait for instructions. That delay, called latency, makes real-time interaction clunky and slow. By putting all that computing power on the device itself, a robot can see, think, and act in an instant. This is critical for navigating a chaotic warehouse or safely interacting with humans. It's the difference between a robot that follows a script and one that can truly improvise. Now, get this. Right now, robotics is a tiny fraction of Nvidia's empire, accounting for just 1% of the company's total revenue. And yet, that tiny division is on fire. The combined unit for automotive and robotics just reported a staggering 72% annual increase in sales, hitting $567 million in the last quarter alone. The growth is explosive. And if you need more proof, CEO Jensen Huang just went on the record, calling robotics the company's single largest growth opportunity outside of its core artificial intelligence business. This is their next big bet. It's why giants like Amazon, Meta, and Boston Dynamics are all lining up using Nvidia's Jetson chips to power their own ambitions. One Nvidia vice president laid out the strategy perfectly, stating, "We do not build robots, we do not build cars, but we enable the whole industry." That single quote is the key to their whole playbook. This isn't just about selling hardware, it's a strategy to become the Intel Inside for the entire robotics age. But it goes deeper. Nvidia has built a powerful software ecosystem, like its CUDA platform, that developers use to program the chips. With over 4 million developers locked into this system, it creates a powerful moat around their business. Switching to a competitor isn't just difficult, it's incredibly costly and complex for these companies. They aren't just selling a chip, they're selling the central nervous system for an entire technological revolution. It all leads to a critical question. What happens when a business that's only 1% of your revenue today is growing at 72% a year and has the potential to become the foundation for nearly everything that moves tomorrow? All market information is subject to change, and this content does not constitute investment advice. We were just talking about Nvidia's strategy to enable an entire industry. Well, that concept has a flip side, which brings us to our next story. The world's largest wealth fund, a $2 trillion behemoth, just made a move that's sending shockwaves from Wall Street to the Middle East by dumping nearly $3 billion in assets. What's crucial to understand is that a fund this massive, with stakes in over 8,000 companies, doesn't make these decisions lightly. They have a sophisticated system to police their investments. The fund's Council on Ethics uses a powerful mix of high-tech and old-school investigation. They employ AI to scan reports from over 80,000 media outlets and analyze complex global supply chains, but they also rely on investigative journalism and direct engagement with affected communities on the ground. It's a massive, ongoing due diligence operation. On the chopping block, US industrial giant Caterpillar and 5 major Israeli banks, including Bank Hapolim and Bank Leumi. The reason? A blistering report from the fund's ethics watchdog, citing an unacceptable risk that these companies contribute to serious violations of human rights in situations of war and conflict. This isn't a suggestion, it's a multi-billion-dollar verdict. The Fund's Council on Ethics didn't mince words. On Caterpillar, it stated, "There is no doubt that Caterpillar's products are being used to commit extensive and systematic violations of international humanitarian law. The report specifically calls out the use of company bulldozers in what it terms the widespread unlawful destruction of Palestinian property." This situation presents a fascinating duality for companies that make dual-use hardware products that can be used for both legitimate construction and, in this case, alleged destruction. Interestingly enough, technology exists that could potentially prevent this. Solutions like geofencing, which uses GPS to create a virtual boundary for a machine, or even remote deactivation. Some construction firms already use geofencing to prevent theft. The big question is whether it's feasible or even legally enforceable for a manufacturer to remotely shut down equipment it has already sold. The rabbit hole goes deeper. The 5 banks were divested for their role in financing Israeli settlements in the West Bank. The Council's report claims these financial services are a necessary prerequisite for construction activity in settlements that the United Nations top court has found to be illegal. This is a financial earthquake. The fund liquidated a $2.1 billion stake in Caterpillar and another $661 million from the banks. So how do you dump that much stock without sending the price into a nosedive? You don't just hit a giant sell button. Instead, they use what are called dark pools, private, anonymous trading venues, and sophisticated algorithmic trading. These computer programs break the massive sale into thousands of smaller, randomized trades over time, hiding their actions from the public market. It's a stealth liquidation executed with surgical precision before the public announcement is made. This move forces a critical question for every major investor and corporation. Where is the ethical red line in a globalized economy, and who will be the next to cross it? The precedent it sets is huge. First, it was physical equipment like bulldozers. Then, it was the banks providing the financing. The next logical step for this kind of ethical scrutiny could be the tech sector. Think about it. Software companies, cloud computing providers, or cybersecurity firms whose services might be used by entities implicated in human rights violations. This move by Norway's fund puts the entire tech industry on notice that they could be next, forcing them to look much harder at who their customers are and how their digital tools are being used. Speaking of massive multi-billion-dollar strategic moves, our final story today is a real head-scratcher. A corporate giant is spending $18 billion to effectively undo its own biggest move. Keurig Dr Pepper just announced it's acquiring Dutch coffee company JDE Peet in a blockbuster deal. But the market's reaction tells the first part of the story. Keurig Dr Pepper's stock immediately plunged 11%, while JDE Peet's soared 15%. The market is essentially signaling that it loves the idea of JDE, Peet's powerful coffee brands being folded in, but it has lost faith in Keurig Dr Pepper's current structure. That stock plunge is the price of admitting the old strategy failed. But that's not the whole picture. The real turning point isn't the acquisition, it's the demolition. Following the deal, Keurig Dr Pepper plans to split its entire operation into 2 separate companies, one for coffee, one for beverages. This move completely unwinds the massive 2018 merger of Keurig and Dr Pepper Snapple, a deal that was worth nearly $19 billion. This is where the situation takes a more complex turn. The architect behind this entire play is a powerful investment firm called JAB Holding. They are the major force behind both Keurig and JDE Peet's, and their end game is clear: to build a single, dominant, pure play coffee company that can go head to head with the global king of coffee, Nestlé. This isn't a retreat. It's a strategic realignment for a much bigger war. Wall Street is buzzing. Top analysts are now on the record with one Barclays note saying the original 2018 merger was a surprise to begin with, calling it an odd and very left field deal with questionable logic. The reason that original merger had questionable logic is now crystal clear. The big idea in 2018 was that a diversified company selling everything from Dr Pepper soda to Keurig coffee pods would create powerful synergies. After all, those synergies never really showed up. Selling coffee and selling soda are 2 very different businesses, and smashing them together didn't create the powerhouse they expected. The driver for this massive reversal, Keurig Dr Pepper's US coffee division, is struggling with shrinking sales, and this is a high-stakes play to fix it. Now, that struggle isn't just a simple sales dip. Keurig has actually been fighting a battle on multiple fronts. First, there are the environmental concerns, with billions of their plastic K-Cup pods ending up in landfills, turning off a growing number of consumers. Second, there was a major consumer backlash when the company launched a new brewer that locked out cheaper third-party pods, which led to a 22% drop in machine sales. And finally, you have the rise of serious competition from brands like Nespresso that offer a higher quality experience. The at-home coffee game has changed, and Keurig was getting left behind. The plan is to create a new coffee titan with $16 billion in annual sales and a separate beverage powerhouse with $11 billion. This isn't happening in a vacuum. With reports that Coca-Cola is also exploring a sale of its Costa Coffee business, the question is clear. Are we witnessing the great unwinding of the beverage conglomerates as giants scramble to fix their caffeine problem?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.